Hey everyone, and welcome. Today we're getting into a really important question, especially for those of us in India. It's all about your financial house. Are you building it on solid rock, or is it maybe on sand? We're going to explore why getting your security sorted out before you start chasing big investment returns is the real secret to financial peace of mind. So let's get right into it. So let me just ask you straight up. Is your financial house built on sand? I know it's a bit of a heavy question, but it's one we absolutely have to ask. Because a strong house, well, it can handle any storm that comes its way. But a weak one, it can all come crumbling down when you least expect it. And it is so easy to get distracted. Every single day, we're just bombarded with talk about SIPs, the next hot stock, or some crypto that's supposedly going to the moon. The pressure is on to just dive right in and start investing, right? It feels like you're missing out otherwise. But hang on, let's just pause and compare these two approaches. If you jump into investing first, you're playing a high-risk game. You're leaving yourself totally vulnerable to life's shocks, and that leads to really stressful bad decisions when things go wrong. But if you build your foundation first, it's the complete opposite. You get security, you're stable, and you get that thing we're all really after: peace of mind. Okay, so how do we actually build this super strong foundation? Well, it all comes down to three crucial pillars. Now, these aren't the glamorous, exciting parts of finance, I'll admit, but they are the absolute bedrock of real financial strength. Pillar number one is your financial shock absorber. We're talking about an emergency fund. Now, this isn't money for a holiday or a new gadget. This is your first line of defense for a real crisis. Like a sudden job loss or a medical emergency in the family. It's what stops you from having to sell your investments at the absolute worst time. So how much do you actually need in there? Well, for an Indian family, the recommendation is a bit higher than what you might hear globally. You really want to aim for 6 to 12 months worth of your essential living expenses. And that's because, our job market can be a bit volatile, and many of us have responsibilities towards our extended family. And where does this money live? The most important thing is that you can get to it fast and it's safe. It can't be tied up in the stock market, so think things like high-yield savings accounts, liquid mutual funds, or even bank FDs that have what's called a sweep-in facility, which just means the money is there when you need it, no questions asked. All right, on to our second pillar, life insurance. And let's be crystal clear about something. This is not, and I repeat, not an investment. Its one and only job is to act as an income replacement for your family if, God forbid, you're not around anymore. In the Indian context, where one person's income often supports many others, this is completely non-negotiable. So, what's the right amount of cover? A pretty good rule of thumb is to aim for about 10 to 15 times your current annual income. That sounds like a lot, but it's what ensures your family can pay off any loans, fund their education, and just keep going without a major financial shock. But what kind of life insurance should you buy? Look, when you break it down, the choice is pretty obvious. On one hand, you have simple term insurance. It's pure protection. You get a huge amount of cover for very low cost. It's simple, it's transparent. On the other hand, you have these complicated plans like endowments or ULIPs that try to mix insurance and investing, and frankly, they do both poorly, often giving you tiny returns. For pure protection, a term plan is hands down the way to go. And that brings us to our third and final pillar, your shield against disaster, health insurance. A single major trip to the hospital in India today can cost lakhs of rupees. It can literally wipe out years and years of your hard-earned savings in a matter of days. Health insurance is what protects your wealth from that. And just look at this. It's a race you literally cannot win on your own. Your savings might be growing at, say, 6 or 7% a year, but medical costs in India, they're going up by a crazy 10 to 15% every year. You just can't outsave that kind of inflation. Your only real defense is a good health insurance policy. So when you're picking a plan, what should you look for? A few key things. Make sure the total amount insured is enough, at least 10 lakhs for a family in a city. Check that they have a big network of hospitals where you don't have to pay cash. And this one is critical. Make sure there are no caps on the room rent. That little detail can end up costing you a fortune. Okay, that's a lot of what and why. So let's get to the how. Let's walk through a super simple, practical action plan that you can literally start on today. It's really just a 4-step process. First, figure out your numbers. How much do you spend each month? What cover do you already have? Second, prioritize. If you're the main earner, life insurance probably comes first. Third, just start that emergency fund, even if it's with a small amount each month.
And finally, use the tools the government gives you to make this whole thing cheaper. And yeah, this last point is a big one. The Indian tax system actually wants you to do this stuff. You can get some pretty significant tax deductions for your health insurance premiums under Section 80D and for life insurance under Section 80C. This basically means you're getting a discount on building your secure foundation. Now, before we move on, we have to talk about the common traps people fall into. Because honestly, knowing what not to do is just as important as knowing what to do. I absolutely love this quote. Buying insurance as an investment is like using a life raft as a cruise ship. Think about it. A life raft has one critical job, to save you in an emergency. A cruise ship is for a long, enjoyable journey. You wouldn't use one for the other's job, right? It's the same thing here. Keep your protection and your investments completely separate.
And here are a few other big mistakes we see all the time. Thinking the insurance your company gives you is enough. It's not, and it vanishes the day you leave your job. People also just wildly underestimate how much medical treatments cost today. And a huge one? Not being 100% honest about pre-existing health issues. That can get your claim rejected right when you need the money most.
So what happens once this foundation is built? What's next? Well, this is the exciting part. This is where we get to shift our focus from just protection to building real, lasting prosperity. See, this is the real magic of it all. When you know deep down that your family is protected no matter what, it gives you the mental strength to stay invested when the markets get scary. You won't be the person who panic sells everything at the bottom. Instead, you can make calm, smart decisions and actually build long-term wealth. And then you get to build the rest of your financial house with all those exciting tools we talked about earlier. You can confidently start your mutual fund SIPs, invest in PPF, buy stocks, or even look at real estate. But you're doing it all from a position of incredible strength, not from a place of fear or desperation. So I'm going to leave you with this final thought. Once your foundation is truly secure and you have that incredible peace of mind, the question you get to ask yourself is no longer, am I safe? It's, what amazing things will I build on this? The possibilities? Well, they're endless. Thanks so much for joining me.